Look, we're still pretty constructive. We've been pretty much constructive all year. And I think basically from our perspective, if the labor market holds in, remains solid, then you want to continue to run long equity risk. You know, the Fed just took up their nominal growth expectations. They're, getting ready to cut. It seems like regardless of what goes on, you're looking at something on the order of 8 to 10% EPS growth for the S&P 500. So yeah, we're still pretty positive. We're still comfortable owning equity markets here.
You sound like you make this argument a lot. Do you get a lot of skepticism out there?
I mean, less now than there was 12 months ago. But it's funny. I've been accused of being bullish. I've never really felt bullish, but I have been accused. Look, people are still concerned. I think there's still an element of the Fed's going to break something, and that hasn't happened, and we need to be concerned about that. And there are some glimmers of a little bit of risk on the labor side of the economy, which I think folks are really focused on as well. But look, after 20% last year, and we're almost up 10% again this year, I think most people are in the markets, might just be doing it in a more cautious way.
What does that end up entailing, though? Does it become sort of a rotation where people then look for, I guess, those stocks have been laggards, or does this maybe represent an opportunity for that money to flow out of equities into other asset classes?
I mean, our view is you still want to stay in equities here. Equities have outperformed bonds significantly in the first quarter, but historically, when that happens, equities tend to outperform the next quarter as well. So, we're not necessarily running for the hills from that perspective. I think, we do believe in the broadening out of performance in the equity market. It's happening in a very slow and steady fashion, I guess I would say. You got those Mag 7 were about 2/3 of market cap gains last year. This year, they're at about 40%. So they're driving less of the returns. We are broadening out a bit, but if you've watched small cap at all recently, you can see it hasn't gotten all the way down.
It hasn't gotten there all the way. We saw the S&P 400, the mid caps, hit a record high, what was last week, and the Russell's still got a ways to go, but it's kind of slowly inching up there. I mean, people have clearly sort of woken up to this idea that there is something else out there other than just, NVIDIA and Microsoft or whatever.
And I think that's right. But our view is that was actually the right decision last year. Last year, you had very narrow EPS growth, and that drove very narrow equity leadership. You had, I think, 3 sectors last year generated year-on-year EPS growth. That's going to be 8 sectors this year. So our view is this broadening out isn't necessarily a price phenomenon. It's more of an earnings phenomenon. And we are starting to see earnings broaden out, and therefore you should have broader participation in the markets from our perspective.